Imagine you open your brokerage app tomorrow morning and half your portfolio is gone. Not because the companies went bankrupt, not because the world ended, but because you thought you were investing, when in reality, you were just gambling with nicer vocabulary. This video is a breakdown of The Intelligent Investor by Benjamin Graham, the book Warren Buffett calls by far the best book on investing ever written. And I'm going to turn its 600-plus pages into a clear, no BS system you can actually use to protect and grow your money. If you stay with me, you'll walk away with three things. 1. A 10-second test to know if you're investing or just speculating. 2. A simple way to choose the right strategy for you, defensive or enterprising, without ego. 3. A practical checklist you can use before your next trade so you stop donating money to Mr. Market. Let's start with the brutal truth Graham discovered. You've been told that investing is about beating the market, finding the next Tesla, or timing the perfect bottom. Graham's core insight is the opposite. He says, an investment is an operation which, after thorough analysis, promises safety of principal and an adequate return. Anything else is speculation. Notice what's missing. No mention of hot tips, no mention of this can't miss. No promise of 10 times in 6 months. It's about process, not prediction. So here's your first tool, straight from Graham's philosophy. Before you put a single dollar into anything, pause and ask 3 questions. 1. Have I done thorough analysis, or am I trusting a story? 2. Is my principal reasonably safe if I'm wrong? 3. Is the expected return adequate, not amazing, just fair, for the risk? If you can't honestly say yes to all 3, you're not investing, you're speculating. And Graham doesn't say speculation is evil. He says speculation is deadly when you lie to yourself and call it investing. Now, why do smart people still blow up their accounts? Because they let a crazy business partner run their life. Graham calls him Mr. Market. Imagine you own a private business with a partner who shows up every day with a new mood and a new price. On Monday, he's euphoric. Your share is worth $200. Buy more before it goes to the moon. On Thursday, he's depressed. Everything is doomed. I'll sell you my shares for $80. Same business, same assets, same cash flow, just different moods. Most people treat the stock market as if Mr. Market knows something. Graham's rule, Mr. Market exists to serve you, not to instruct you. Your job is not to react to every quote. Your job is to wait until his mood swings, give you a price that's clearly in your favor. So here's your second tool. When prices fall and the business is still solid, think, my crazy partner is panicking. This is a discount. When prices soar and nothing fundamental has improved, think, my crazy partner is manic. This is an exit opportunity. You do not have to respond to every quote. You only need to act when price is far below value and you have a margin of safety. Which brings us to the cornerstone of the whole book. If you remember only one technical phrase from The Intelligent Investor, make it this, margin of safety. Graham borrows this from engineering. If a bridge is designed to hold 30,000 pounds, you don't drive 30,000-pound trucks over it. You drive 10,000-pound trucks. The gap is your margin of safety. Investing works the same way. If you estimate a business is conservatively worth $100 per share, an intelligent investor doesn't happily pay $97. Graham wants you paying $70 or less. That gap between what you pay and what the business is worth is your protection against 3 things. Your own mistakes, bad luck, reality being messier than your spreadsheet. For very stable businesses, the discount can be modest. For more fragile or uncertain companies, Graham wants you buying them at 2/3 or less of their conservative value. So the third tool, before you buy anything, write this down. My best estimate of intrinsic value is, I'm actually paying. My margin of safety is %. If that last number doesn't make you feel slightly greedy and very patient, you're overpaying. At this point, you might be thinking, okay, I get the ideas, but what does this look like as a real-world portfolio? This is where Graham does something most books never dare to do. He tells you bluntly that not everyone should be an active investor. He divides the world into 2 types. The defensive investor, risk-averse, busy, not obsessed with spreadsheets. The enterprising investor, willing to work hard, analyze deeply, and stomach being wrong alone. Neither is morally superior. What matters is matching your strategy to your temperament and time. If you're defensive, your main goal is to avoid serious mistakes and sleep at night. Graham's prescription is simple. Hold high-quality bonds and a diversified basket of solid stocks or index funds, and don't get cute. He even gives you a base rule. Keep your portfolio around 50% stocks and 50% bonds, and only move between 25-75 and 75-25 when markets get obviously extreme. Here's the beauty of this mechanical mix. When stocks crash, your bond allocation cushions the blow and gives you dry powder. When stocks soar, rebalancing forces you to sell high without trying to time the top. No forecasts, just rules. So here's your fourth tool. Decide right now. Are you defensive or enterprising? If you don't love analyzing businesses and reading financial statements, you're defensive. That's not an insult. That's intelligent self-knowledge. If you're defensive, write one line. My default allocation will be 50% broad stocks, 50% high-grade bonds or cash equivalents, rebalanced once or twice a year. That single sentence will protect you more than 1,000 hot takes on social media. But what if you are the enterprising type, the one who wants to dig deeper? Graham lays out strict, almost brutal criteria before you pick individual stocks. He's not impressed by stories, he's impressed by survival and discipline. For the defensive investor, his checklist looks like this in plain English. The company is big and established, not a tiny speculative flyer. It has a solid balance sheet, enough current assets to comfortably cover its short-term debts and not overloaded with long-term debt. It has earned money consistently for at least 10 years in a row, including during recessions. It has paid a dividend reliably for decades. Earnings per share have grown over time, even slowly, and the price is not crazy. The P/E ratio is moderate. The price compared to assets is reasonable, and together they don't imply wild optimism. He compresses those last valuation rules into what later became known as the Graham number, a rough ceiling on how high a rational price should go, given the company's earnings and book value. Most people never apply anything close to this discipline. They buy because a line on a chart points up and someone on YouTube sounds confident. So here's your fifth tool, your pre-trade checklist. Before buying a single individual stock, ask 1. Is this business large and established, or am I chasing a story? 2. Does it have a strong balance sheet not drowning in debt? 3. Has it been steadily profitable for at least 10 years? 4. Has it rewarded shareholders with a consistent dividend history? 5. Has earnings per share actually grown over the last decade? 6. Is the current price moderate relative to both earnings and assets? Or am I paying for hype? If you cannot check most of these boxes, Graham would tell a defensive investor, pass. There will always be another pitch. Now let's pull all of this together with a simple story you can map onto your own life. Picture two versions of you, 5 years from now. Version A is the smart speculator. They watch financial news every day, jump in and out of hot themes. AI this year, clean energy next year, crypto the year after. They feel brilliant when prices spike and sick when they crash. Their returns swing wildly. After taxes and mistakes, their net progress is meh. Version B is the intelligent investor. They make a different decision today. They admit their true type and choose a defensive or enterprising path honestly. They write down a simple policy. I invest only when I have a margin of safety, and I let Mr. Market serve me instead of scare me. They either follow the 50-50 stock-bond rule with regular rebalancing, or, if they truly love the work, they pick a handful of boring, profitable, conservatively valued businesses and hold them for years. 5 years later, which version is more likely to still be in the game? Compounding calmly? Graham's answer is clear. Wealth goes to the people who avoid ruin, not the people who chase excitement. So here's the 3-point framework you can steal from the intelligent investor. 1. Process over prediction. If your decision isn't grounded in thorough analysis, safety of principle, and adequate return, it's speculation. Label it honestly or don't do it. 2. Margin of safety everywhere. Whether you're buying a stock, a bond, or even a business, insist on paying less than a sober estimate of value. The gap is your insurance against being human and being wrong. 3. Temperament beats IQ. Your biggest edge is not finding genius forecasts. It's staying rational when Mr. Market is manic. When others panic, you stick to your rules. When others are euphoric, you quietly take profits or do nothing. Let's make this painfully practical. Right after this video, do just one move from Graham's playbook. Take out a sheet of paper and write your personal investment policy in 2 or 3 sentences. I am a defensive, enterprising investor. My core strategy is 50/50 index funds and bonds/concentrated portfolio of carefully analyzed value stocks. I will only buy when I have a clear margin of safety, and I will treat market drops as offers from Mr. Market, not as verdicts on my intelligence. Put the date on it. That document becomes your shield the next time you feel the urge to chase a meme stock or panic sell in a crash. Because in the end, Graham's message isn't outsmart everyone. It's outdiscipline yourself. You don't control the economy. You don't control interest rates. You don't control the next headline. You do control your process, your margin of safety, and whether you let a moody partner named Mr. Market run your life. If this breakdown helped you reframe how you think about investing, and you want the full depth behind these ideas, grab The Intelligent Investor, the link is in the description, and actually read it with this framework in mind. Because in markets ruled by emotion, your real unfair advantage is simple. You refuse to play the emotional game.